The more intelligent you are, the more dangerous your financial decisions can become. That sounds counterintuitive. It shouldn't be true. But it is, because intelligence doesn't eliminate bias. It amplifies it. And in the next few minutes, you'll see exactly why some of the smartest investors in history lost billions. And why? You might be more vulnerable than you think. Some of the smartest investors in history, Nobel Prize winners, lost billions. Long-term capital management was run by financial geniuses. In 1998, their models failed and nearly destabilized the global financial system. And it's not just hedge funds. In 2024, the average investor underperformed the S&P 500 by 8.48%. Not because of lack of intelligence, but because of behavior. The real risk isn't being uninformed, it's believing you're immune. Smart does not mean rational. For decades, behavioral economists like Daniel Kahneman have shown that the human brain is not a perfectly logical machine. It is a survival machine. And survival thinking does not always translate into smart investing. Our minds are wired with systematic biases, invisible mental shortcuts that once helped us stay alive. Today, those same shortcuts quietly sabotage financial decisions. The uncomfortable truth? Intelligence doesn't remove these biases. Sometimes, it makes them stronger, because the smarter you are, the better you become at justifying your own mistakes. Let's start with one of the most powerful forces in human psychology: loss aversion. Research shows that losing $100 feels roughly twice as painful as gaining $100 feels good. That asymmetry changes everything. It explains why investors hold losing stocks for too long, why they refuse to admit mistakes, why they panic sell during downturns. The brain interprets financial loss as threat, and when the brain senses threat, logic shuts down. Now consider another trap: the sunk cost fallacy. This is a tendency to continue investing time, money, or energy simply because you've already invested so much. Even when walking away would be rational, we tell ourselves, I've already put too much into this. But past costs are gone. They are irrelevant to future outcomes. Yet our brains resist letting go, because admitting a loss feels like admitting failure. And intelligent people often struggle the most with being wrong. Then there's confirmation bias, the tendency to search for information that supports what we already believe and ignore what contradicts us. The more intelligent you are, the more convincing your internal arguments become. You don't just make a bad decision, you build a case for it. You gather evidence selectively, you reinterpret warning signs, you protect your identity as a rational thinker, and slowly, without realizing it, you drift further away from objectivity. These biases are not signs of stupidity. They are features of being human. But unless they are recognized, they quietly shape financial outcomes. And intelligence alone is not enough to stop them. If loss aversion is about fear, overconfidence is about ego. And ego is far more dangerous, because fear makes you hesitate. Ego makes you act. Overconfidence is a tendency to overestimate your knowledge, your skill, and your ability to predict outcomes. It is the quiet belief that you see what others don't, that you are more rational, more disciplined, more informed. But markets do not reward confidence. They reward accuracy. And accuracy is far rarer than confidence. Research consistently shows that investors who trade more frequently, believing they can time the market, tend to earn lower returns. One landmark study found that men traded 45% more than women, and as a result, significantly underperformed. Not because they lacked intelligence, but because they overestimated it. Overconfidence creates the illusion of control. The belief that complex systems can be mastered through analysis alone. That if you just gather enough information, you can eliminate uncertainty. But financial markets are not machines. They are ecosystems, driven by millions of unpredictable participants. Even the most sophisticated mathematical models cannot remove randomness. Long-term capital management believed they had solved risk. They built advanced models. They hired brilliant minds. They used enormous leverage. And when the unexpected happened, their confidence became their collapse. The danger of overconfidence isn't loud. It doesn't feel reckless. It feels intelligent. It feels calculated. It feels justified. And that is precisely why it's so powerful. High intelligence does not remove emotion. It simply hides it behind logic. In financial markets, two forces dominate behavior: fear and greed. Fear appears during uncertainty, when prices fall, when headlines turn negative, when volatility rises. Even experienced investors feel it. The tightening in the chest, the urge to do something, to act, to escape discomfort. And in those moments, knowledge fades. History is forgotten. Long-term strategy is abandoned. Fear converts temporary losses into permanent ones, not because investors lack intelligence, but because the brain interprets uncertainty as danger. And when the brain senses danger, it prioritizes survival over rational analysis. On the other side of the spectrum is greed. Greed feels very different. It feels exciting, optimistic, hopeful. When markets rise rapidly, when everyone seems to be making money, the fear of missing out begins to grow. FOMO is not irrational enthusiasm. It is social pressure. It is the discomfort of being left behind. During asset bubbles, highly educated individuals often participate just as eagerly as everyone else, not because they failed to analyze risk, but because momentum feels convincing. When prices keep rising, the brain interprets that as confirmation, and confirmation is emotionally rewarding. But markets do not move in straight lines. And when momentum reverses, euphoria turns into regret. The same people who felt confident at the top feel panic at the bottom. What makes this especially dangerous is that intelligent individuals rarely describe their decisions as emotional. They describe them as strategic. They tell themselves it was a calculated risk, or the data supported the move. But often, the decision was driven by emotion first, and justified by analysis later. Fear and greed are universal. No degree, no IQ score, no experience level grants immunity. Human beings are social creatures. We look to others for cues, especially in uncertain environments. Financial markets are filled with uncertainty, and when we don't know what to do, we observe what everyone else is doing. This is herd behavior. When many people buy an asset, it creates the impression that it must be valuable. If everyone is participating, it must be safe. But popularity is not the same as value. History is filled with bubbles. The dot-com frenzy, the housing boom, meme stocks, cryptocurrency manias. Each time, brilliant engineers, doctors, analysts participated alongside everyone else, not because they were irrational, but because social proof is powerful. When large groups of people act in unison, it creates psychological comfort, even if the fundamentals are weak. And when the crowd reverses direction, the same dynamic accelerates panic, buying high, selling low. Repeated, again and again. The herd offers emotional safety, but often financial risk.